And joining us right now is Paul Meeks. He's Independent Solutions Wealth Management Portfolio Manager. Paul, there's been a lot of talk about how far some of these tech stocks have come down. And as a result, there are people who are pretty eager to buy if they see any good news. You're kind of in a wait and see mode. You're not ready to jump in and buy just yet. What are you waiting to see?
I want to make sure that when these companies report that they're not going to give guidance that makes me and other analysts, lower at least considerably, going forward revenue and EPS estimates, because even though stocks may be cheap, you may say something like, hey, man, they're down 60, 70, 80%. They cannot rally, or they can't rally and hold those gains if we continue to lower estimates. So let's see. Let's clear the news cycle. There is absolutely no rush to engage. And afterwards, we'll reassess. I'm hoping to be pleasantly surprised, but I really think that there's going to be continued pressure here on almost all of the FANGs and the major tech companies.
Because you think it's not going to be possible to get any certainty into the future, or because you think they know what the future is and it's not going to be great?
I think that they're going to be, even though they may indicate that they're seeing some sort of turn, that they have some sort of confidence, I don't really think that even the best on their internal teams can really say that. And so we have to see what unravels with the recession and how recession sensitive are some of these companies. You have the digital advertisers like Alphabet and Meta that are obviously going to be more impacted. You have somebody like even Apple that is geared toward consumer electronics. We know that there's some trouble there. So let's just see what happens. Also, we want to see with the major tech companies, do we finally, after years and quarters of very aggressive growth in the cloud, do we start to see a deceleration? These cloud companies, AWS at Amazon and Azure at Microsoft and Google Cloud, they've been growing very nicely in their cloud business, and all the focus has been there. They've been growing every quarter for quite some time, 30, 40, 50%. If we start to see a deceleration, there could be some hell to pay. Let's
kind of split some of these companies out. They're not all created equally, and they're not all down equally. You could talk about how Microsoft is down by 26%, Alphabet down by 29%, but they look a heck of a lot better than somebody like Meta, who's down, what is it, more than 60% right now? How do you kind of look at these? Are you more interested in getting what you think could be a really great deal from a stock that's dropped significantly, or is there a reason that you'd be drawn to some of these stocks that haven't fallen as much because you think they have a better story?
I think the better stories are companies, and you see the ones that they're in line with the NASDAQ this year, maybe even outperforming, companies like Microsoft and Alphabet. A lot of people ask me about Alphabet and Meta. Paul, aren't they the same thing? Aren't they both digital advertising companies? Well, Alphabet is a little bit more resilient because they are search ads, whereas Meta is social media driven. And of course, Meta also is going through a wrenching change, going from their legacy business to the metaverse, whatever that may be. And so a company like Meta might be very intriguing because it's down the most, but it also has the squirreliest go forward business plan.